Next up, I'd like to invite on stage Maneesh Dangi, Co-Chief Investment Officer, Birla Sun Life Asset Management Company.
On the slide there, the tallest and the brightest yellow chart belongs to Birla Sun Life. We've been lucky over last couple of years, almost a decade, to kind of have delivered about 65-70% of our asset that we manage. And we manage a lot of money, about 1 lakh crore as we speak, in fixed income. So about 65-70% of that in almost a decade has been in top quartile. I didn't want to show the top 2 quartile because all 100% of our funds have been in top 2 quartile. So we've been lucky. I call it we've been lucky because mathematically, you would call in a comparative landscape that it's somewhat improbable. Anyways, over next couple of minutes, I will try and share the secrets of our success, but don't share it with our competition. Over next couple of minutes, I'll kind of talk of the broad guiding principles that we have as an investing team and how we try and weave with various strategies across the platform that we manage, about 10, 12 platforms, the big platform that we manage. The first big guiding principle is our belief that markets are inefficient. It's a core belief because at least in Indian fixed income market, there are so many opportunities, so many times markets get dislocated, and you can literally exploit them if you're well-researched. This happens because, unfortunately, Indian fixed income markets are under-researched and under-equipped that our participants are. And which is why almost every single year, you'll have seasonal and cyclical opportunities coming your way to kind of, you could literally exploit. There are many such examples across the industry. I like to talk about, what we've done. Over the last 5-10 years, we have this gilt index fund. You kind of launched it for a lot of investors who were keen investing only in something which is more index-sized. The thing is that the performance of a gilt index fund has been really bad. If you were to look at vis-a-vis the actively managed gilt fund, which has kind of delivered more than 1 to 4% higher almost every single year. Almost similarly, other funds, there is this famous instrument in India called FMPs. People love it because it gives you a certainty of return. But I want to highlight that over the last 5, 7, 8, 10 years, our standard liquid plus fund, which kind of runs substantially lower interest rate risk, have out-delivered FMPs almost consistently every single year. Another example is of dynamic bond fund over the last 7, 8 years. Bala talked about it. Across market cycles, rate cycles, the fund has been able to out-deliver FMP or FD-like instrument in excess of 250 basis points almost consistently. So in a sense, the core belief, at least within my team, is that look for opportunities in the market. Yes, the public data is available to everyone, but if we are actually well-researched and exploit them well, we'll be able to beat markets well. The other core belief that my team has is that we try and stay disciplined to the fact that markets tend to mean revert. Now it's easier said than done because generally you will have these popular views, the quite dominant views every second, third year, which will talk about this time it's different. You would see that in 2000.com. Maybe you could say that in 2013 on INR. You would see the same thing more or less when in July, August, September of 2012 or 2013, interest rates were trading at 9%. That this time it's different. People will talk about inflation would settle higher because it had stayed at higher levels for too long. But the whole discipline, at least as a fund house that we tend to have, is that unless there is an absolute huge data available to us to believe that it's a new territory that markets, facts, or prices are going to settle in, we can keep the historical backdrop right and tend to only play the mean reverting big themes. Just about a couple of months back, about 2 months back, across our carry funds, and we manage about 45,000 crore of carry funds, which focus on 1 to 3 years of duration strategies. We tapered our duration because we saw 10-year bond had climbed down to 7.5% from good 9.25 about a year back. Yes, you would hear a lot of newspapers and big stories, and from fund managers hearing these stories that interest rates are going to go down dramatically. We've been of the same view for the last 1 year, but because interest rates had kind of mean reverted and the growth was recurring, it was at least you could start to see growth in a couple of years' time, which is why we chose to taper duration across the board. So in a sense, this theme is we try and play almost regularly. I'll give you another example. Something like inflation. Right now the dominant belief, the popular belief in the market is that inflation will get to about 4%. We don't disagree with it. Of course, for the last 2 years, people who follow us would know that we were one of those very, very few ones in the markets. Late 2012 started talking of how inflation would get to 6 and eventually 4 in 2016. It did happen, and we did not disagree with it. What we disagree with the market is that this core belief that inflation would settle at 4%, and the cost of that would be just about 150 or 200 basis points of real rate. Now, this is simplifying way too much, and which is why we don't disagree with RBI also that inflation could be tamed. And could be tamed at 4%. What we disagree with RBI is that the cost of that will be just about 150 to 200 basis points. Given that the historical backdrop of Indian inflation in the last 50 years is a lot closer to 7 to 8%, it'll be extremely difficult to tame inflation at 4%. Yes, it'll be tamed, but most probably the real rate in India would be a lot higher. Of course, a lot of you and your investors should be really happy because, most probably in the next 1 or 2 decades, the fixed income would be able to deliver a decent real return. Because the last 50 years, if you had invested in any of these big FDs, every single year, in net real basis, you would have literally earned negative returns. Broadly, we run about 3 strategies: duration, carry, and liquidity. But the point that I wanted to make here is that unlike a lot of other competitions of ours, we kind of have dominant strategy in each of the fund, we try and ensure that each fund actually has all the 3 strategies: liquidity, carry, and duration playing for it. So I'll give you an example. Something like medium-term fund is about $1 billion fund. The dominant strategy of the fund is carry. So the whole idea is to look for opportunities. Bala talked about 55, 60 companies that we have lent to in that space, which offers us good carry through good structures. Yes, that's the dominant strategy, but we also play for duration and liquidity out there. So something like July 13 would happen. Interest rates will be hiked by about 3%. It's a great strategy. Any common sense view would give you a sense that, look, it made sense to kind of buy bonds, 10-year bond, 5-year bond out there. So we kind of doubled the duration out there. Similarly, across carry funds, we added substantial duration. So medium term has a core strategy, which is carry strategy, but it played duration in 2014. Given that the markets are kind of unwound most of the cancerous high interest rates that we had about 1.5 years ago, we've kind of unwound the duration out there. Also, in each of these funds, we'll try liquidity strategy in a sense that there are seasonal opportunities off and on in the markets, where you will see these CD rates, shooting up. We'll try and exploit these opportunities across the board. So, the big point I wanted to make here is that unlike majority of the competition, where as I said about medium-term plan, wherever there is a dominant strategy, people try to kind of standardize the other 2 pieces. So most of the accrual funds in the market, would kind of run, very, very standard, constant duration portfolios. We don't do that, and which is why most of these funds, something like medium-term fund or dynamic bond fund, have been able to generate substantial delta. I can't frankly generate the delta that Mahesh can, which is why the answer of Bala should have been frontline equity. But in the space that I operate in, where the competition is literally those 40 boys from a variety of mutual funds and the fixed deposits of 30, 40 banks, I'm able to create that good 1, 3, 4, 5% delta across all these funds. I do it with lot less volatility. So I would have said, instead of Bala, that okay, come in dynamic bond fund. Now, once you kind of decide, the kind of what's dominant strategy you will have in each of these funds, the whole trick is how to time the market in a sense that, how to go long or short. You can't really talk about equity because in long term, you'll make a lot of money in equity. Fixed income, unfortunately, is a mean reverting asset class. Rates go up and come down in net. In long term, you only earn coupon. So if you have to be literally beating markets, you're going to be timing markets well. So, our thesis of timing the market is various across 3 different strategies. In the duration funds, we tend to be a lot more contra. So you would see us in 2008, 2012, and 2014 14, much ahead of the competition, actually talking a lot about duration and adding substantial duration across our funds. We tend to be contra because the movements in duration category, the 10-year, 15-year, 30-year bonds, they tend to be non-linear. They unlike equity where they do not price it incrementally. Most of the times, market would settle in a tight range for a couple of months, and suddenly there'll be a breakout on either side when the critical mass develops for any particular substantially different view. So this is why we tend to be somewhat contrarian, which is why you would see much ahead of the curve in duration in actually cutting and adding duration across the bond funds. We also can do it, of course, in duration because stop losses are quite easy in a sense that you could actually trigger stop losses without so much of an impact cost. Compare duration with, let's say, large cap stocks. If you understand equity well, it's quite easy to sell government bond of 5, 10,000, 20,000 crores. Just about 2 months back, we sold more than 15,000 crore of a government bond because we wanted to neutralize without really impacting the market. You can't do that, of course, in carry, which is more of a credit strategy, and which is why in the carry strategies, we tend to be somewhat pro-cyclical. Allow me to explain what it means. Pro-cyclical essentially means that we'll allow the data to come in, we'll allow the management, the bandwidth, the corporate balance sheet to improve, the macroeconomic conditions to improve, and then only we'll go and lend to the companies. In a sense, that's not, to be contrarian is not possible in a carry strategy because there are no stop losses possible because you can't literally unwind any exposure that you've underwritten in any of the company because markets are fairly illiquid in that segment. So we tend to be a lot more pro-cyclical. We are happy to actually be number 2 or number 3 in lending to a company because so there is no great rush in duration. You would see it much ahead of the curve. In carry, as I said, we'll be 2nd or 3rd in actually lending to a company because we literally want a lot of data to improve. Finally, on liquidity is a little bit nuanced. We frankly are neither contrarian nor pro-cyclical. We're unique there because we are more just in time. In liquidity, you would understand people who follow markets well that, again, they're non-linear. You can't literally be contrarian because, let's say, if you go long too early, you would add too much of vol to the funds, which my investors are not comfortable with. If you actually get in too late, then most probably you would have missed the opportunity because majority of corrections tend to take place in liquidity in a fairly quick time horizons, which is why we tend to be just in time in a sense that we will watch for the data. Lehman moment happens, 2008, next 15 days, cut the duration across the board. May 10 happen, 3G announcement is made, 30,000 crore going to be withdrawn. Okay, we're running large duration across our liquidity and carry portfolio, cut the duration sharply, create a lot of liquidity. Same thing, 21st May, taper talk happens. Over next 15 days, you would see our duration across our carry funds, across our liquidity funds, down to 3rd or 4th quartile. So we're just in time. The reason that we've been able to do well and actually beat FMPs and beat competition so consistently in these funds is essentially because we're not really emotional about the positions that we've undertaken. We try and cut them really, really sharply. So believe me on this, you can actually check my end May 2010 Liquid Plus funds and carry funds duration that I ran, and in a month's time, my team had actually cut the position so sharply that we were actually on the 4th quartile. So in liquidity, we tend to be, as I said, just in time. Finally, what kind of companies do we lend to? Of course, there are standard templates that rating agencies run. We have about 4 analysts tracking about 200 odd companies that we lend to, and there are, of course, standard leverage coverage ratios of each companies, how to assess the financial health of the company. But there are a few unique things that we try and do, which is somewhat, do not get captured, of course, in the general modeling that, all of us resort to while analyzing companies in fixed income. First of all, we kind of tend to focus a lot more on financial flexibility in terms of, do you have the plan B? And which is why there's focus on, collateral, because we wouldn't lend to a company where the whole theme is to return money basis the financial health of the company that we're lending to. So which is why flexibility, interlinkages with larger groups and so on and so forth important for us. Also, what is important for us is vintage. So you won't see Birla Sun Life lending to a lot of companies who kind of came in 2007, 8, raised a lot of money in NBFC space. We won't lend to them because we would watch them settling down. They need to literally prove for 5, 7, 8 years, meet us, meet our analyst every year and present to us as to how they are on course to become decent companies. And then, maybe in 2014, 15, we'll start to think of lending to these companies. Apart from that, the kind of companies that we don't lend to, we generally don't, we kind of avoid companies who are, politically affiliated, especially run by politicians, let's say. We kind of avoid resource companies because there's too much of government linkages. And finally, we having decided who to lend to, we try and ensure that majority of these structures are wrapped in a manner that we get proximity to the promoter. His skin should be in the game in terms of his guarantee or his wife's guarantee. He have to be a lot closer to the collateral in a sense that to make sure that my collateral becomes both tangible and enforceable. And then finally, I kind of make a potent mix of financial covenants so that I get ahead of everyone, while there is a decay happening in the company. So that could be done by, how at some levels of leverage coverage ratios, the current ratios and variety of such things, profitability-wise. If company starts to decay, we kind of try and put a lot of these covenants so that we get our money back earlier than others. So when you look at, our portfolios, you will find that majority of them are actually there in many of our competitions also. But the look and feel of would be actually different because we have a large balance sheet. Don't call it balance sheet, but we have a large AUM, about 1 lakh crore, the largest in the country in the fixed income space. So what we are able to negotiate with the companies in the bilateral trades that we do is that we try and ensure that a lot of these covenants that I talked of, a lot of these collateral improvisation that I talked of, do come in enough in our what do you call it, structures that we produce with the borrower. So it kind of helps us in bad situations to kind of get out ahead of the rest of the camp. Finally, reminiscing how last 7, 8, 10 years have been. And I wanted to share this big point that almost every single year you're going to be taking one big call, right? Frankly, this whole theme which runs in markets and across investors and also few fund managers love it. In the name of dynamic bond funds, moving duration from 1 to 10 every 6 months, frankly, that doesn't add so much of a value. Every time you're going to be taking, every year you're going to be taking one big view on macro and micro, and then accordingly, kind of place your bets. If your bets are well taken by the market, you would end up delivering substantial outperformance. I also wanted to highlight that almost every single year over the last 7, 8 years, we've won awards from 2 or 3 rating agencies, variety of agencies which are listed on the screen out there in terms of Fund House of the Year awards. I started with a slide that how mathematically improbable it could be to deliver a 70% performance, Q1 performance. If you actually look at our 10-year performance, majority of funds of ours would fall in the top decile, in a sense, top 1 or 2 across categories. So what big calls did we take in 2008, 2012, 2014? The whole idea was to be ahead of the market and actually adding substantial duration, and we did that. Also, the whole idea, you remember, a lot of you would remember how in dynamic, especially after July 13, we actually doubled the duration. That's much publicized. What is not publicized is in Treasury Optimizer Fund, which is about $1 billion, MTP, Stop, and many such funds. We literally doubled our duration, and and as we speak, we've already tapered the duration. So every single year there'll be a core theme, in a sense that right now the theme is actually carry, because I think the corporate balance sheets will improve, the macro conditions are likely to improve, and therefore let's look for some pro-cyclical credit opportunities, and you will be able to exploit them well. So again, as I said, in 2010 and 2013, when 21st May happened, within 15, 20 days, as a fund house, we were literally running large positions, especially in liquid plus and carry funds, in terms of being extremely illiquid and in top quartile of duration. Over next 15 days, as I talked about the just-in-time strategy in liquidity, we kind of unwound the duration substantially, which is why in each Lehman post-3G outburst of markets and 2013, each of these, you need to judge the fund manager as to how in bad times he delivers more than how good he delivers in good times. And which, if you look at the performance of our schemes across these 3, 2008, 10, and 13, you would see us in top quartile across our carry funds and what do you call it, Liquidity Plus. So it's been a fulfilling journey over the last decade or so. We hope to do so for next many decades for you. Thank you.